Welcome to Clever Money Hacks, the channel where money moves and life improves. In today's episode, we'll be discussing Japan's economic crossroads, the debt, the demographics, and the plummeting yen.
It really does sound like a distant topic, something for the foreign policy wonks. But when you actually peel back the layers of the sources we have today, it feels less like a news report and more like a suspense thriller.
I have to be honest with you right up front. When I saw Japan's economy on the schedule, my first thought was, okay, haven't we heard this song before?
Right.
I feel like ever since I was a kid, the narrative about Japan has been stagnation, lost decades, slow growth. It's almost background noise.
Yeah.
So challenge me here. Why is this moment different?
That is absolutely the right skepticism to have. For a long time, Japan was just stagnant. It was treading water. But the data we're seeing now suggests they aren't treading water anymore. They're starting to take on water. The structural integrity of the world's fourth largest economy is being tested in a way we just haven't seen in the modern era.
Okay, so give us the back of the napkin sketch. What are the flashing red lights?
It's the convergence of three things hitting all-time extremes at the same time. First, the debt burden has hit $10 trillion.
Okay.
Second, the yen has collapsed to multi-decade lows against the dollar. And third, and this is the scary one for the finance nerds, the yield on their 30-year bonds just hit an all-time high.
We are definitely going to unpack all of those, especially the bond yields, because I know that sounds abstract. But before we get into the mechanics, I have to ask the selfish question for our listener.
Sure.
If I'm driving to work in Chicago or sitting in a cafe in London, why does Japan's balance sheet matter to me? Is it just an isolated island problem?
I wish it were, but it absolutely affects you. And the reason is, sitting in a vault in Tokyo, Japan is the largest foreign holder of U.S. Treasury bonds.
They own over $1 trillion of American debt.
Wait, $1 trillion?
$1 trillion. So they are essentially America's banker.
In a very real way, yes. Now play that out. If Japan's domestic economy gets into enough trouble, if they need cash desperately to prop up their currency or save their banks, what do?
They sell their assets.
They sell the family silver. They sell those U.S. Treasuries.
And if they dump $1 trillion of U.S. bonds onto the market, basic supply and demand kicks in.
Exactly. The price of bonds crashes, which means the interest rate, the yield on U.S. debt spikes.
And since U.S. Treasury rates set the floor for everything else.
Your mortgage rate goes up. Your car loan gets more expensive.
So if Japan sneezes, the global debt bubble catches a cold, and my monthly mortgage payment could potentially skyrocket.
Precisely. It's a global financial trigger.
Okay, that raises the stakes significantly. You have my full attention. Let's open up the hood. The source material refers to the elephant in the room, which is the debt.
The $10 trillion question.
Right. The number in the report is a debt-to-GDP ratio of 260%. I see numbers like that, and I know it's bad, but I don't really have a reference point.
It is frankly astronomical. Think of it this way. It means the Japanese government owes 2.6 times more money than the entire country's economy produces in a single year.
2.6 times.
Wow. To put that in perspective, the United States is around 120, maybe 125%, and we have political battles over that level constantly. Japan makes every other developed nation look fiscally conservative.
But hold on. Japan has had high debt for years. People have been predicting this collapse for 2 decades, and it hasn't happened. They keep building trains, life goes on. Why hasn't it imploded?
That's the magic trick. They survived because, for a long, long time, money was essentially free. Interest rates in Japan were pinned at zero, or even negative.
Okay, I like the analogy one of the articles used. It's like having a massive credit card balance, but you managed to snag a 0% APR introductory offer.
That's a perfect way to put it. It doesn't really matter if you owe $10 million if your monthly interest payment is zero. You can carry that balance forever without feeling the pain.
But the intro offer is expiring, isn't it?
That is exactly what is changing right now. As global inflation rose, bond yields in Japan started to creep up. And here's the brutal math problem. When you owe $10 trillion, even a tiny increase in the interest rate makes your monthly bill explode.
The source highlighted a stat about the budget that honestly shocked me.
The budget squeeze. Practically speaking, the Japanese government now spends 25% of its entire annual budget just on debt service.
Wait, let me make sure I heard that right. 1/4 of the entire national budget.
Yes. And that's just paying the interest, not the principal. That is just the cost to keep the bank from foreclosing.
So before they pave a single road, pay a single teacher, or fund a single hospital bed, 25% of their tax revenue is just gone.
Correct. That is the definition of opportunity cost. It's dead money. And if rates go up further, that 25% becomes 30, then 40. It becomes a feedback loop that eats the entire budget.
And this creates a trap, right? They need to print more money to pay the debt, which causes inflation, which drives rates higher.
That is the debt trap. And it connects directly to the second crisis flashing red on the dashboard. The currency. The yen.
We've seen the headlines. The yen is trading at what, around 156 to the US dollar? That's incredibly weak.
It's largely due to something called the interest rate differential. It sounds technical, but it's actually just human behavior.
Okay, break it down for us.
In the U.S., the Federal Reserve raised interest rates aggressively to fight inflation. So you can put your money in a U.S. savings account and get a 4 or 5% return, risk-free.
Right. Cash actually pays you now.
Exactly. But in Japan, the central bank kept rates near zero. So if you're a global investor, where do you put your money? Do you keep it in yen and earn nothing? Or do you swap it for dollars and earn a guaranteed 5%?
You buy dollars, you sell yen. It's a no-brainer.
And when everyone does that at once, the selling pressure tanks the value of the yen.
Which, on the surface, might sound like a problem for Wall Street traders. But Japan is an island nation. They don't have oil. They import a lot of their food.
Correct. Almost all their energy. And those things are priced in dollars. So when the yen is weak, it costs way more yen to buy that barrel of oil or that bushel of wheat.
So this leads to imported inflation. The average person in Tokyo is seeing the price of gas, electricity, and food just shoot up.
Yes. And we have to pause here to emphasize just how much of a cultural shock this is. For the last 30 years, Japan hasn't been fighting inflation. They've been fighting deflation.
Right. I remember reading about the deflationary mindset. In Japan, the smart move was to stuff cash under your mattress because things would be cheaper next year.
That was the golden rule for an entire generation. Cash was king. But now, inflation is averaging around 3%. That might sound manageable to an American listener, but for a Japanese saver, it's a catastrophe. That cash is suddenly burning up.
So the financial rules that everyone lived by are suddenly obsolete. That has to be terrifying.
It creates a sense of panic, and it forces the central bank, the Bank of Japan, or BOJ, into an impossible position.
The rock and the anvil scenario. So why can't they just raise interest rates to save the yen?
Because of the debt we just talked about. If they raise rates, the interest payments on that $10 trillion skyrocket, and the government goes bankrupt.
Okay, so they can't raise rates, so they keep rates low.
And if they keep rates low, the yen keeps crashing, and people get crushed by the cost of living.
They're completely trapped.
They are. And this brings us to the mechanism they've been using to keep this all afloat. You've probably heard the term quantitative easing, or QE.
Yeah, it's one of those terms that gets thrown around, but I feel like 90% of people just nod along. What have they actually been doing?
In plain English, the government prints money to buy its own bonds.
That feels like cheating.
It's certainly market manipulation on a grand scale. Normally, a government issues a bond, and if investors aren't interested, the government has to offer a higher interest rate to entice them.
Right. If nobody wants to lend you money, you have to sweeten the deal.
Exactly. But Japan didn't want interest rates to go up. So the Bank of Japan stepped in and said, fine, we will buy the bonds. They artificially kept the interest rates low by being the biggest customer in the room.
And when you say biggest customer, what are we talking about?
Oh, we're talking about the Bank of Japan now owns over 50% of all Japanese government bonds. They didn't just manipulate the market, they became the market.
Wow. So half the national debt is owed to the bank that printed the money to buy the debt.
Essentially, yes. It's a closed loop. But since 2022, because of inflation, they've had to back off. And when the biggest buyer steps away, bond prices fall and yields rise. That is the spike we are seeing now. Gravity is finally taking over.
So we've got the financial trap, but the sources point out that this isn't just numbers on a screen. There are real-world pressures making this worse. Let's talk about the geopolitical angle.
This is a really fascinating piece of the puzzle. You'd think with the yen being so cheap, a 30–40% discount, tourism would be booming. And if you go to Tokyo right now, it is packed with Americans and Europeans.
So what's the problem?
The problem is a massive hole where the big spenders used to be, mainland China.
Is this still a COVID thing?
It's not COVID. It's politics. It stems from remarks made by a prominent Japanese politician, San Tai, regarding Taiwan. These comments really angered Beijing.
And China uses tourism as a diplomatic weapon.
Immediately, they effectively discouraged travel to Japan. And the impact is huge because Chinese tourists were the shopping tourists. They were buying luxury bags, high-end electronics, cosmetics in bulk.
So the tour buses are missing from the shopping districts.
Exactly, and that hurts the small businesses. But frankly, even that pales in comparison to the ultimate headwind, the factor that underlies everything else.
We're talking demographics.
The Sloan Ocean crisis.
Yeah.
Japan is shrinking, and not just a little bit. Its population peaked in 2010 at 128 million, is now around 125 million. By 2050, it is projected to drop below 100 million.
Just to visualize that, that's like the entire population of Texas just vanishing.
In just a few decades. And it's not just that there are fewer people, it's who is left. The median age is 49. There are now more people over the age of 65 than under the age of 15.
There was one statistic in the notes that I honestly had to read 3 times.
The diaper stat.
Good diaper stat.
Japan now sells more adult diapers than baby diapers.
That is. It perfectly explains the economic problem.
It's the why behind the debt crisis. Think about the tax base. You cannot grow an economy or pay off a massive national debt when your workforce is shrinking every single year.
Right. And at the same time, your pension costs and healthcare costs are skyrocketing.
It's a demographic pincer movement. You're burning the candle at both ends. All the financial engineering in the world can't fix the biological fact that there are physically fewer people to do the work.
So this paints a pretty grim picture. What is the end game here? Are we looking at a total collapse?
Well, the source discusses 4 potential paths. First, there's the debt crisis scenario, a total currency collapse.
Yeah.
This is the doomsday option. Economists think it's possible, but unlikely. The Japanese system is surprisingly resilient.
Okay, so hopefully we avoid the total meltdown. What about technology? Can't they just invent their way out of this?
That's the technological revolution scenario.
Yeah.
Using AI and robots to offset the labor shortage.
Robots taking care of the elderly, automating construction.
Essentially. It's a great theory, and they are trying it, but it's still very theoretical. Robots don't pay income tax.
Good point. What about immigration?
The immigration reform path. But Japan has historically been very resistant to large-scale immigration. It would require a huge cultural shift.
Which leads us to the most likely scenario, according to the source. Managed decline.
Managed decline. It sounds a bit depressing, doesn't it?
It sounds like admitting defeat.
But it might actually be pragmatic. It means accepting slower growth, maybe no growth. It means focusing on maintaining safety and quality of life, even as the economy shrinks relative to the rest of the world.
So Japan stays a rich, advanced country, but it stops trying to be the economic engine of the world.
Exactly. It's a graceful exit from the rat race.
Yeah.
They become a sort of boutique, nation high-quality, low growth.
That is a fascinating concept, but let's bring this back to our listener one last time. Why should we be watching this experiment?
Because Japan is the canary in the coal mine.
How so?
Because they aren't the only ones aging. Japan is just ahead of the curve. China is aging rapidly. South Korea, Europe, even parts of the U.S. are heading towards similar demographic cliffs.
So we're watching our own future play out in Tokyo right now.
We are. Watching how Japan handles this, whether they manage decline or spiral into crisis, is a preview of what the rest of the developed world might face in 20 or 30 years.
That is a sobering thought. Before we wrap up, though, is there any silver lining, an opportunity here?
There is actually a significant investment angle. A weak yen means Japanese companies are essentially on sale for foreign investors.
Right. I saw in the notes that Warren Buffett has been buying heavily in Japan.
He has. His thesis is likely that these are stable, cash flow-rich companies that are incredibly cheap right now because of the currency exchange rate.
So if you believe Japan can manage this decline without collapsing, there is tremendous value in their market.
Precisely. It's not all doom and gloom. It's high risk, but potentially high reward.
You know, this conversation really challenges the assumption that success for a country always means growth. We're so used to looking at GDP going up, but maybe Japan is showing us a different kind of challenge.
It's a question of redefining prosperity. Can a society be happy and stable with a shrinking population and a stagnant economy? Japan is running that experiment for all of us.
Here's where it gets really interesting to think about. If managed decline is the future for the developed world, are we ready for it? It's something to mull over.
It certainly is.
Thank you for listening to today's episode. And don't forget to like, subscribe, and share your ideas for future episodes. See you next time.